You're watching episode 37 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and before we get started, I invite you to join our Facebook group and our newsletter. Links to both of those are in the description of this video. Today's topic is all about cost segregation studies. What is a cost segregation study, and why would I ever want to use one? Real estate investors benefit from something called depreciation. Depreciation tracks the deterioration of a rental property over time, specifically 27.5 years for residential property and 39 years for non-residential property and most short-term rentals. Depreciation is best explained with an example. So let's assume that I buy a $300,000 rental property and I have to allocate $25,000 of that to land, leaving me with $275,000 worth of depreciable basis, technically called your adjusted basis or your improvement basis. I depreciate that $275,000 of basis over 27.5 years, residential rental property. That means that I get to claim $10,000 of depreciation expense every single year for 27.5 years. So I can cash flow or have net operating income of $10,000 a year that can hit my pocket, but then I can turn around and tell the IRS that I actually made $0. In some cases, I can tell the IRS I actually lost money. Actually, most rental properties lose money on your tax returns after you factor in depreciation. So even though $10,000 of cash flow hits my pocket, I get to turn around and tell the IRS I made $0 because I'm getting an annual depreciation expense of $10,000 because I bought this property. I paid $300K for it up front, and I get to track that. I get to basically draw down on that, expense some of that every single year for 27.5 years. It does not matter how you finance the property. You could pay all cash. You could finance it 100%. You could go 25% down, 30% down. Does not matter. Your depreciation expense every single year in this example will still be $10,000 a year. A cost segregation study says in that $275,000 of basis that we are depreciating over 27.5 years, in that are components that are not actually going to last 27.5 years. Instead, we have things like our carpet and our appliances that are only going to last 5 years or 7 years. We also have land improvements that are only going to last 15 years. A cost segregation study is the practice of taking that $275,000 of improvement basis and allocating it between 5-year, 7-year, 15-year, and 27.5-year property. So think of a cost segregation study as spreading that $275,000 out into more accurate buckets that more align with the actual useful life of the components that make up those buckets. A refrigerator is not going to last 27.5 years, but it might last 5 years. So you will see an allocation of $1,500 after a cost segregation study to my appliances, and it's sitting in my 5-year bucket. Now, here's where it gets really beneficial. Thanks to the 2017 Tax Cuts and Jobs Act, we can now use 100% bonus depreciation. It used to be 50%, but now it's 100% bonus depreciation on any component with a useful life of less than 20 years. So if I do a cost segregation study and I take this $275,000 and I allocate it between 5-year, 7-year, 15-year, and 27.5-year property, I might end up with about $60,000 allocated to my 5, 7, and 15-year property. And thanks to bonus depreciation, I can 100% expense any component with a useful life of less than 20 years. Well, my 5, 7, and 15-year property, they all have useful lives of less than 20 years, meaning that in my example, I can immediately 100% expense the $60,000 of value allocated to my 5, 7, and 15-year property. So a cost segregation study allocates value to 5, 7, 15-year, and 27.5-year property, but it also allows you to immediately use 100% bonus depreciation to write off the full value of your 5, 7, and 15-year property in the year of acquisition. Now, the real critical thing to understand here is that this is a tax arbitrage play. What that means is that I'm going to get a big tax benefit for taking this upfront depreciation. If I claim $60,000 of depreciation today, my tax benefit might be $20,000. I get that tax benefit and now I can go and reinvest that. And let's say that I earn 8% per year or something like that. So I'm going to take this $20,000, I'm going to go reinvest it. At some point, I'm going to have to pay that back. Whenever I sell the property, I have to pay depreciation recapture taxes. There's three types of depreciation recapture. There's Section 1245 recapture, Section 1250 recapture, and also unrecaptured Section 1250 gain. Those are the three types of depreciation recapture. At some point when you sell your property, you will have to pay depreciation recapture taxes on all of the depreciation that you have taken. And that can be a very expensive tax bite. So it's really important to understand that I'm getting this $20,000 tax benefit up front thanks to my $60,000 of bonus depreciation in my $300,000 purchase price example. And I'm going to take that $20,000 and reinvest it. And hopefully I'm going to accrue enough earnings over a hold period of 7 to 10 to however many years. And when I sell the property, I'm going to be ready to pay that $20,000 back. But over time, the earnings from reinvesting that $20,000, that's what I get to keep. So that's really what's in it for anybody that's bonus depreciating, anybody that's running cost seg. It's that tax arbitrage play. If you can't use your losses, if your losses are passive and you don't qualify as a real estate professional, you can't make them non-passive. If your losses are passive, then the bonus depreciation is just going to add to your suspended passive losses. So it may not be as beneficial as getting that immediate tax benefit up front that you can then go reinvest, because the passive losses, if you cannot use them, get suspended and carried forward over time. We have other Tax Smart Daily videos all about that, so go check out our prior episodes if what I just said confused you and you need to go and educate yourself on the passive activity rules. I believe the Tax Smart Daily episode number 1 talks about real estate professional status, so start there. So you really only want to do a cost segregation study if you can create losses that you can utilize today so that you get that tax benefit today that you can then go reinvest today and start accruing earnings on that tax benefit, because at some point you will have to pay that tax benefit back. Thanks so much for watching another episode of the Tax Smart Daily. Check out all of our social channels below. We'd really love to have you follow us online. And if anything that I say resonates with you, or if you had any questions, please drop me a line. I really appreciate anybody that takes 10 to 30 seconds out of their day to engage with me. It's you that keeps bringing me back to the table. So thank you very much for doing that.